Higher yields, inflation, and Trump coming into office. I'm Anton Kulikov, and I'm here to give you the scoop on what's happening in the markets for January 2025. In the month of January, the stock market started the year with a little bit more fear baked in than we saw most of last year. And this was mostly because interest rates on the longer end of the yield curve continued to rise more than anticipated. In fact, the 20 and 30-year yields on US Treasuries have been approaching 5%, which is the highest they've been in a very long time. This, coupled with the onset of potential inflation, has sparked a little bit of turbulence in the stock market. Now, Trump coming into office helps level off this fear a little bit as people and investors are confident about his policies going into this year, but there still remains elevated levels of fear and volatility in the markets. So let's go ahead and dive into the first point, which is higher interest rates. So recently in the bond market, which is a good gauge to track different interest rates on different points of the yield curve, longer term rates along the 20 and 30-year benchmark have reached 5% this month. And this has kind of sparked a little bit of worry with investors because higher interest rates, generally speaking, aren't good for the stock market. So as you saw, the end of December and the month of January has basically sparked a little bit of turbulence in the stock market with the S&P 500, which is the broader gauge for US stocks, dropping about 3% from the middle of December into the first couple weeks of January. One of the reasons for this elevated level of fear in the stock market in the latter part of last year and the first few weeks of this year is due to the drop in the price of US Treasuries. Now, what that means is interest rates along the entire yield curve have actually gone up a little bit since the Fed started cutting rates back in September of last year. And this is a little bit counterintuitive. How could longer term interest rates go up when the Federal Reserve, which should be the controlling force of interest rates, actually started lowering rates in September? And this is kind of the thing that's puzzled investors recently because generally speaking, the Fed sets the target for not only short-term interest rates, what it directly controls, but that should theoretically flow into the rest of the yield curve. But weirdly enough, since the Fed started cutting short-term rates, what's happened is short-term rates have kind of gone down a little bit, but interest rates that are set on the long end of the yield curve, which affects mortgages, which affects long-term debt, which affects US government bonds, those interest rates have actually risen from under 4% to just over 5% in just the span of the last 4 months since the Fed started cutting rates. And what you see here in the markets is long-term bonds on average have dropped over 15% in that time period, one of the worst periods for long-term bonds in the last decade, and by far the worst performing asset in the entire market from the time the Fed started cutting rates. Traditionally, longer term rates going higher for regardless of what reason isn't good for the stock market because as risk-free rates go up, there is less of an incentive for investors to put their money into risky assets. And if the stock market is something that moves around a lot, that's considered a risky asset, whereas long-term bonds, you can now get, instead of 4%, you can get 4.5%, you can get 5% risk-free. There's more of an incentive for capital to flow out of the stock market and into long-term bonds, hence the reason why the market's faltering a little bit. Now, this leads into the second point of what's happening in January, and that's the onset of slightly higher inflation. Recently, in the first couple weeks of January, we've seen some macroeconomic numbers that have come out that have proposed that inflation may be coming back. Now, we're not talking about the type of inflation we had in 2022 or 2023, but we are talking higher inflation today than we did see at the end of 2024. Obviously, any talk about inflation is bad for all markets, stocks and bonds included. So that's why you see a little bit of volatility and selling pressure come into the stock market due to inflation pressures. Now, personally, I don't think that's going to be a major issue. That may be transient, maybe just a little bit of a blip higher after the reduction in inflation that we've had through the latter part of 2024. But nonetheless, that is something that has happened in the last couple months, and that has definitely sparked a little bit of fear in the stock market. Regardless of the reason why, we do keep an eye on that, as that is probably the biggest risk to this market is increasing inflation that could definitely derail the nice rally we had back in 2024. So now moving on to the final point, the biggest impact in January for the stock market, obviously, is the incoming administration. So for the most part, investors seem very, very optimistic in the last part of 2024. Obviously, election day produced one of the best days for the broader stock market that we've seen in all of 2024. However, as of producing this video on January 14th, the S&P 500 actually gave up all of its gains since the rally that was marked by the Trump presidential election. Now, this is a little bit of an interesting development because after Trump got elected president, there was a lot of optimism. And then obviously all these inflation fears and the fears of higher interest rates basically took the market all the way back down. Although we are seeing a little bit of relief in the latter part of this trading day on January 15th, markets have seemed to recover a little bit. But regardless, January has definitely not been marked by a smooth transition into 2025, to say the least. Traders can definitely pinpoint January as one of the most turbulent months for the stock market in the last year. And that's, again, mainly for all these factors conflating. I do believe that the Trump presidency going for the rest of this year will produce a little bit more volatility than people expect, only because whenever there's change in the markets, good or bad, in the interim, right when the change happens, there does seem to be more elevated risk and a lot of fluctuation regardless of what the change is. So even though whatever investors are expecting for the Trump presidency to be, whether it be good or bad, the onset of the actual presidency in the first few weeks, maybe the first few months, may be a little bit turbulent for the market simply because of the fact that there are going to be more unknowns. And obviously with Trump being more of a wild card when it comes to certain policy, regardless if it's good or bad policy, that may spark more uncertainty for the market in the short term. So it's just something to keep in mind as we go into the rest of this year. I think if we're going to rank the top three threats that we're seeing in the month of January, that's inflation, higher yields, and the Trump presidency, I think we can pinpoint that higher yields definitely going to be the largest threat to the growth of this market, followed by inflation. Although inflation seems to be coming back a little bit in the month of January, I don't think it's going to be a standing issue. I think it's more of a transient issue. And then finally, the Trump presidency, based on the reaction we saw back in November on the onset of election day, I think over time, as the year kind of progresses, we may see a little bit of volatility, but I don't think we're going to see an outright collapse or a correction. What I do think that the Trump presidency will create for the stock market is actually a little bit more opportunity to be more active in the market. So not necessarily, and that's why I'm putting it in last place when it comes to threats, because I don't think that it's a threat as so much of an opportunity to make more money as the market fluctuates. Because the thing is, when markets go up and up and up, at some point it kind of becomes tough to make money as an active investor, which we as an organization are, only because there's so much you can do when the market goes up and does nothing else. What you really want in a healthy market is fluctuation, right? You don't want massive fluctuation, you don't want crashes, you don't really want huge moves in either direction. You just want a lot of active opportunities in the form of market fluctuation. And that's generally a healthy thing for markets as well. So as a trader, I think the Trump presidency, for better or for worse, will bring a lot more price fluctuation to the markets. And I think that's going to make for a pretty profitable 2025, regardless of what the policies actually are. Those wrap up the things that I'm seeing in the month of January and probably going to be the most impactful in the markets for the rest of this year. The point of this channel is to build a community of active traders and investors to exchange ideas so that we can become more profitable in what we do and potentially tweak our own strategies in ways that we didn't even see before. So thank you so much for watching, and thank you for becoming a part of that. My name is Anton Kulikov. Thank you so much for joining, and I'll see you in the next one.